Hi, everyone. Welcome back to Be Rich podcast. I hope you guys are enjoying this. It's something new which you've started. The feedback so far and the view counts have been looking good. So we've decided to continue with this. It would be nice if you guys can put in your comments and your feedback down below so we can tailor make this more to suit what you guys are looking for. More than picking topics we think you will be interested in. We like to cover topics, especially on the podcast, on topics which would be of interest to you. That being said, we are working on a podcast which will cover the terms, basic terms, and usages of words and related to stocks and trading, terminologies which are used in shares and trading. So that should come out soon, that podcast. So keep an eye out for that. Today's podcast, I thought we'll talk about investing rules from some of the world's greatest investors. These guys are the gurus of investing. In investing, it's better to mimic an investment strategy that works for successful investors rather to invent something by yourself. A new investment strategy is more likely to lose money. If you want to achieve good returns by investing in a stock market, learning from great investors of all time is a great way to do that. This is one of the main reasons you guys watch Anand and listen to what Anand has to say. So you won't have to reinvent the wheel. So it gets easier to invest and to emulate what Anand is doing, to follow his strategies. More than picking the company he is exactly picking, it's better to learn why he's picking, how he's picking, so you can learn to pick your own stocks. Let's learn some of these investing rules from our greatest investors of all time. So this will help us in our journey to become better investors and stand out from the crowd. One of the greatest investors of all time is Ben Graham, margin of safety. This investing rule has made Warren Buffett and other famous investors billions of dollars. The margin of safety concept was developed by Benjamin Graham, known as the father of value investing. The margin of safety means you buy a stock for less than its intrinsic value. The difference between what you pay and the intrinsic value of the company is called the margin of safety. If the difference between what you pay and the intrinsic value of a security is big enough, then you can expect to make an exceptional return on that investment. When a margin of safety is positive, you buy a business for far less than what it's worth, and you expect the price to rise in real value when the market recognizes the company's actual worth. The margin of safety has helped Warren Buffett in his journey of investing, and it's the most important thing he learns from Ben Graham about investing. The concept of margin of safety can help you minimize your downside and increase your upside on any investment. Ben Graham was wiped out during the Great Depression, which led him to develop this concept of margin of safety. He figured out that if he buys even a terrible business for less than what they are worth, he still could make money on that investment. Ben Graham strongly believes that it's not what you buy that enhances your return, but what you pay that influences your return. Remember, it's not what you buy that makes you money, it is the price you're paying for it that makes you money. Whenever you look for an investment, make sure you pay less than what it's worth and leave a margin of safety to minimize the downside and increase your upside. If you want to learn in detail about margin of safety, I recommend you guys read The Intelligent Investor and Security Analysis by Benjamin Graham. Warren Buffett famously said, also have to have the knowledge to enable you to make a very general estimate about the value of the underlying businesses, but you don't cut it close. That is what Graham meant by having a margin of safety. You don't try and buy businesses worth $83 million for $80 million. You leave yourself an enormous margin, Warren Buffett said. The next great investor guru we want to talk about is Phil Fisher. Buy a quality business with a good management was his philosophy. This is quoting from Phil Fisher. If you are in the right companies, the potential can be so enormous that everything else is secondary. For every $1,000 I and my clients put into Motorola in 1957 is now worth near $2 million after all the ups and downs of the stock and the stock market. If I had sold Motorola because I thought it was overpriced 10-15 years ago, chances are I would have not known when to get back in and I would have missed the enormous profit. If one of my stocks gets overpriced, I warn my clients that things are maybe unpleasant for a little while, but they will rise soon to a new peak. This is what Phil Fisher said. Most investors know that Benjamin Graham influenced Warren Buffett in his investing journey. But Fisher's investing strategy had more influence on Warren Buffett's investing strategy than any other investor. Benjamin Graham had taught Warren to buy companies at less than what it's worth and leave a margin of safety. It made Warren Buffett a millionaire, but buying quality business with good management made him a billionaire. Phil Fisher wants to buy companies with quality products that don't have many close substitutes in the market. When there are not many alternative products, a company can raise the price without worrying about and not losing a lot of customers because there is no other alternative to the product. Phil Fisher focuses on talking to the management to get an understanding of how the is performing. Although most investors cannot directly talk to the management of the companies, but they can read the annual report to see if the management is honest to their investors about the good and the bad of the business. Graham sells the stocks when it gets overvalued relatively as in its to its current earnings. But Fisher analyzes if the company has a quality product for its customers and a good management. And he may never sell the company as long as the company has good management and quality product for its customers. This is one of the main reasons Anand keeps on talking about ITC. Though some of you have been wondering, ITC sometimes price to book, its book value, if you look at it all this in certain aspects, may not look like a great investment, might look overpriced. But Anand always says you should not sell a company when it has a good management and quality products for its customers. To quote Phil Fisher, he said, "If I have a deep conviction about a stock, but it has not performed after 3 years, I will sell it. If I like the management or the basic institution or the basic situation has deteriorated, I will sell it." So the main reason why Phil Fisher sells anything is if the stock is not performing over a long period of time, or if there's a deterioration in the management or in its product, he'll sell it. When you analyze securities, Graham concentrates on quantitative measurements like analysis of the balance sheet and income statement, while Fisher focuses on more on qualitative measurements like how much a customer values the product or the management's capability. The next person who's a guru of investing, according to Anand and all of us, is Charlie Munger. The wise ones bet heavily on when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. This is what Charlie Munger said. Charlie Munger has been a partner with Buffett for over 60 years and played a big part in making Berkshire Hathaway one of the biggest companies in the world. Charlie has a lot of investing ideas that can help you become a great investor. But one of the investing principles from Charlie can change the way you invest your money. When opportunities come to you and you're more likely to be sure that you are right, then you should bet heavily to get the highest rewards. There are few investment opportunities in life where you'll be right and have a higher likelihood of making higher returns. Charlie thinks you don't need a lot of opportunities to get rich in stock market. You have to wait, and when those few opportunities come, you should be prepared to bet heavily because this type of opportunity comes once in a lifetime. Charlie didn't believe in diversifying his investment into hundreds of companies. Instead, he likes owning companies that he knows will perform better and have a competitive advantage. He thinks you should know a lot about a few companies rather than a few things about every company. Remember this. He thinks you should know a lot about a few companies rather than know a few things about every company. This Anand has been trying to tell you guys repeatedly many times to focus on a few companies and deep dive and study the company, study the management, study how they market, not listen to all the news which is happening, and try to focus on knowing a lot about a few companies than focusing on a few things about many companies. The last guru we're going to talk about is Warren Buffett himself. He very famously said, I will tell you how to become rich. Close the doors, be fearful when others get greedy, and be greedy when others get fearful. This is a very famous quote of Warren Buffett. There are tons of investing lessons to learn from Warren Buffett, but one of the crucial ones is buying when others are selling and sell when others are buying. It looks so simple on the surface, but it's action that is very hard to do for most people. Most people, when they see everybody buying securities, they also want to buy and be part of the crowd. But that's a big mistake. In investing, when you are with the majority, then you think you have to then think about your position all over again. Most of the time in investing, the majority are wrong. The contrarian investors like Warren Buffett have themselves have made themselves rich because of the madness of the crowds. Warren Buffett stopped buying companies during the dot-com boom. At the time, everybody thought Warren Buffett has lost his touch. But when the dot-com bubble burst, everybody was afraid to invest in stock market. That's when Warren Buffett had the last laugh. He started buying companies in 2002 while others were selling. Ben Graham said that you should buy from the pessimist and sell it to the optimist. And that's what investors like Warren Buffett do. And that's what made them so rich. It's so simple to understand, but so hard to practice. If you have that, if you take action on this advice, you're more likely to build wealth on the stock market. So let's conclude. If you follow these rules from the world's greatest investors, you are more likely to increase your likelihood of reaching higher returns. But it depends on you taking action on this great investor's advice because knowing and doing are two different things. These investing rules seem easy to understand, but why most people don't follow them? It challenges human tendencies, which is natural to us. For example, it's natural to do what everybody is doing in the buy market and sell your stock, and that's a wrong thing to do. But people still do it because everybody else is doing it. To be a great investor, you have to do things different from what the crowd is doing, and that is the hard part. Anyway, I hope you guys found this conversation interesting. Remember, in conclusion, I can say first, margin of safety is a strategy you can use. Two, buy quality businesses with good management is the second strategy you can use. Third is to invest in a few companies and not many companies. As Munger said, that's what you should work on. And the fourth is what Buffett has always said: when everybody is buying, you should be selling. And when everybody is selling, you should be buying. These are four things you should keep in mind. And we wish you the best of luck in your investment strategies and your investment journeys. And as I said in the beginning, please do drop it in the comment below what more you would like us to talk about, what more would be helpful to you. All the best. And thank you for joining us today on Be Rich. Please do subscribe to our channel and turn on the bell notification icon so you'll be notified every time we put up some new content for you guys. Thank you.